Hey everyone, this is Kishore. Welcome back to my channel. Today I'd like to share my thought process the possibility of recession coming to US in next 1 year by looking into various historical data cycles and also the current economic data points. This is not a financial advice, just for knowledge purpose only. Let's jump into the show. Periods when to make money. This was created by Samuel Benner. It's a more than 100 years old pattern. Based on the commodity prices, he created this chart and he created with levels A, B, C, and years in A are the panic. In this year, there is a high chance of the panic. Like in 2020, we got the COVID panic. And B, in this years, this is a good time to sell stocks because at this on this years the stock prices are high. And level C, this is a time to buy homes and stock prices because they are very cheap. So he predicted very nice. And in 2020 we had a COVID crash or COVID crisis, and he predicted 2019 is the panic year, which is very close to it, and 2023 is the good time to buy homes and stocks. It is also very close, and 2021 or 2022 are the good times. And again, he's saying in 2026 is the year where you need to sell the stocks or homes because the prices are high. So there is a chance like 20, it can happen in 2025 or 2026. And I made a full video on this chart a year back. I'll leave that link in the below description. And this is the book Benner Proficiency of Future Ups and Downs in Prices, What He Has to Make Money on Pig Iron, Hogs, Corn, and Provisions. So basically, he looked into the commodity prices of this pig iron, hogs, corn, and provisions and come up this chart. So similar to this commodities, current now the commodities are corn, cotton, wheat, and lumber. So this is the lumber futures. So right now they are very close to the 2020 lows, and right now it's a very good support level. We know that home prices are high and home sales are very low. One of the main reason is that one, I think. So if it bounces from this level, that is good for the lumber. And cotton price also going down, and this is also very close to the 2020 and 2021 levels. If it break this support, then it can go back to the 2020 very low, like 45 or 50 levels. And this is corn also going down, and it's a very good support level right now. It is between 2020 and 2021 levels, but if this break this support, then it can go down to the 2020 all time 2020 lows. And this is wheat. This is also going down. It's also very good support level at 2020 levels. If it bounces here, then that is good. So if you see here, corn, wheat, cotton, and lumber all are at support levels, and they're going down. The trend need to be reversed. Like they need to go up from this current support levels. Otherwise, there's a high chance they can go a lot lower. And this is another one, 18-year real estate clock. And this was in the book The Secret Life of Real Estate and Banking. I also made video on this one, and I'll leave the link in the below description. Based on this real estate clock, we are in the 16, like activity slackens means home sales are low or home sales are going down. And next level is foreclosures and bankruptcies increase. And the third one is 18 is stocks enter a bear market from past all-time highs. So you can, this is the chart I made it from that clock, and I put it in my video. You can take a look at that one. And this is home pending sales. Home pending sales have broke down 2020 lows also, and it's going log. Still it is going lower. Let's see pending home sales versus 30-year fixed rate mortgage. As we know, the Fed rate cuts are possible in next month, in this month, in September. So if it helps or not, but in last 1 month, even the mortgage 30-year loans are interest rates are going down. Home pending home sales are not rising up. So this is a little bit concern to me. And this is cards. Other delinquencies are above pre-pandemic levels. So like auto, student loan, mortgage, credit card, other, and HELOC. So credit card and other they are going up, but mortgage loan delinquencies are low. This data is up to March 2024. So based on this, we don't need to worry on the mortgage loan delinquencies. And this is similar suggests in US credit cards delinquencies happen during US recession. So the credit card delinquencies are going up. In the past, it happened during the recession time, not on the regular time. But now, even though we are not in recession, it is going up. So let's see what happens in next couple of months because the unemployment rate is going up. I'll share that chart in next slides. And this one more global liquidity index. This is a 60-month recurring cycle. So we are at here right now, and we know that a lot of countries along with the US, they are cutting the interest rates, so that pumps some money into the economy. And this is predicting the peak is 2026, the peak of global liquidity high, but it can be 2025 also because we seen in the past it did not went up to here. They were went above 60 and then went down. So let's see how it goes in 2025 especially. And this is I shared this chart in last week video also. These are the years the Fed raised the interest rates, except 1994. All other years it is followed by a recession. And in 1990, 2001, these are the main parameters we look into it when there is a recession or not. In 1990 and 2001, employment is down in 1990. That is the cause. And in 2001, industrial production is very very low. So that is one of the reasons for the recession. And this is 2007 2008 indicators, and personal consumption expenditures, employment, sales, all employees total non-farm income and production, all this went down and caused the recession. So I'm going to check all this how they are now. And this is personal consumption expenditure, it is going up, so there is no concern on this chart or on this data. Employment level, this is going sideways, and there is a little bit concern because unemployment rate is going up. In the past, when employment is going up, it is followed by a recession. And this is total industrial production. This is also going flat, but we need to go up for the GDP and economic growth. And real manufacturing and trade industry sales, this is also going flat, and we need to be go up, then that is good for the economic growth. And this is real person income, this is going up, this is good, more than flat, as inflation is going down based on the data. Even if real person income stays same, then that is good. So based on all these data points, two are little bit concerned. One is the unemployment rate, and another one is industrial production. All other data points are looking okay now, but let's see next couple of months how it is going to be. And this all implies total non-farm, this is also okay, there is no concern on this data point as well. And next, coming into US commercial real estate companies are facing roughly 2.2 trillion in maturing debt between now and 2026. We know that commercial real estate is in big trouble, and a lot of foreclosures or a lot of things are happening in that. And 2.2 trillion 2.2 trillion is going to be matured between 2023 and 2026. That's a big amount. Let's see how it is going to happen. This is one of the main concern. If any panic or anything comes, maybe this is one of the area. And this commercial property foreclosures value jumps to more than 20 billion, the most since 2015. Another thing is it is going up continuously from year 2020, it is going up continuously. This is a little bit concern. It need to stop, at least going flat or going down is a good one. Otherwise it will really cause a big trouble. And this is a treasury yield 10 and 2 inverted yield curve. So whenever this inverted yield curve goes from negative to the positive, it followed by recession within 6 months. It happened from 1981, 1989, 2001, and 2008, and 2020 also. So why it is very very important, why it is very sensitive when it goes from negative to positive, why recession follows? Because 2-year yield is highly very correlated with the Fed fund rates. So if you in this chart you can clearly see the above one is Fed fund 2-year yield, and below one is the Fed funds. So when 2-year yield is going down, Fed funds started the rate cuts. So they are very close to each other. And this is another one. Upside is on the top is 10-year yield, and below one is mortgage rates. So 10-year yield is very close to the mortgage 30-year interest rate. So the 2-year is very close to the Fed fund rate, and 10-year is very close to the mortgage interest rates. So what happens is banks take the loans for the short term and lends for the longer term. So between these two interest rates, they make some money. That's called carry trade. So these two are very very important. That's the reason whenever it goes from the negative inverted curve to the positive, followed by a recession. And this is another way when recession start and related to the S&P 500. I shared this chart in my last week video also. uh, Always stock market predicts the economy prior to happen. So S&P 500 peaks before 6 months recession starts, and ends and bottoms before 3 months of recession end. So we can take it with a grain of salt, not exactly 6 and 3 months. It's an average. And this is SPY monthly chart, and the monthly candle is like a hammer candle, looks good, and momentum is going up, and RSI is also going up. So the chart looks really good to me. There is no concern on the chart, and we are very close to the all-time high. But only concern is next couple of months it's a weak seasonality. I mean, there is a chance of going sideways or going down. September and October are very very bearish months, so that is a little bit concern to me. And this, it always looks like a soft landing. In the news you always see soft landing is possible, soft landing, soft landing. And in the news, even in the past, whenever the recession happened, At that time also they had this kind of soft landing news in all over the times. And the summary is Samuel Benner cycle and 18-year real estate cycle are pointing almost the same year, like 2026 or 2025, based on the data we already seen. The COVID crash is 2020, but it predicted 2019. And Treasury yields tended to inverted curve is turned positive. In the past, it acted as a Russian signal. I showed the chart. Tending to inverted curve is going above zero. And in the past, whenever it happened, within 6 months, Russian took place. And I talked about it, what is the importance of the 10-year and the 2-year. Commercial real estate loans are maturity in 2026. 2.2 trillion amount is going to be matured between 2023 and 2026, and we know that we just saw commercial real estate foreclosures are going up, which is not a good sign. That is one of the main concern here. And stock market is entering the weak seasonality. So based on the seasonality, September and October months are very very bearish for the stock market. Let's see what happens, because we saw another chart data point where S&P 500 peaks before 6 months of the recession comes. So that's the reason the weak season, even though it is a weak seasonality, we know a little bit concern on it. Employment data is very important for next 1 year. As we saw, unemployment rate goes up and it followed by a recession. So that is the reason employment data is very very important. And home sales are very low. If unemployment rate increases, there is a chance of home foreclosures may start. So that's one of the main reason I'm saying employment rate is very very important for next 1 year. That's all for today. Hope you like this video. If you like this video, please hit the like button. Please watch more videos in my channel. If you like them, please subscribe. Please hit the bell icon so that you'll get notification when I upload a new video. Please share this content if any of your friends looking similar kind of content. Thank you so much. Bye bye.